Hello and welcome to Aasgard Updates. This is going to be episode number 8, and what I'm talking to you about today is a little update on the value versus growth trade that my two former videos ago on December 1st, we talked about whether or not value is going to come in as a great rotation into the market because the valuations were quite a lot cheaper than they were in the growth stock market. Before we get started, this channel is for investors in the cold stream dividend growth large and the small and mid cap strategies, as well as the Aasgard small and mid cap fund. A couple caveats. This is not financial advice, and nor is it a solicitation for investment. We can't give personal financial advice over the internet like this. We really have to know anything and everything about our clients before we can give proper investment advice. But if you want to drop a comment or give me a question about what the strategies are, how they work and all that, please feel free to drop a comment down below and I can address it on a future video or get back to you directly if you're an investor in one of the strategies. All right, so today, like I said, we're going to talk a little bit about value versus growth. Let me change up my screen here. I'm going to pull up a stock chart here. This is the S&P 500. It's our 3-year chart that we like to look at, and you can see the dramatic downturn we had back in February, late February, early March due to the pandemic and the lockdowns, and the immense bull market that we've been in ever since. And a lot of this move really is based on investor enthusiasm and not much else, because there's not exactly a lot of earnings growth going on over the past year because we've been in recession. But the multiples people have been willing to pay for certain categories of companies have been increasing dramatically, and in particular on the growth side. Investors in the midst of the pandemic, I think many were getting stimulus checks and sitting at home, maybe bored, and they started looking around like, well, what the heck can I do with this money? And they decided on the stocks that everyone knows and loves and maybe interface with. And so things like Microsoft, right? In the middle of the pandemic, everyone's using Microsoft products more intensely as they're working from home. And so people would bid that company up. Makes a lot of logic to it. Electrification of cars. Oh, people are seeing more Teslas on the street. Maybe I should buy some of that Tesla stock. And so companies in those categories, and there's a bunch of others, battery technology, cannabis stocks, you name it. Blockchain has had a moment. All those companies got bid up pretty dramatically all the way up into, this November kind of time frame. And then immediately after the election, we all got the news that the vaccines were going to be available and that they were effective. And that's a big game changer. And that's when we saw a change in the market. And that's what I was alluding to in, like I said, what was that, episode 6, but about this great rotation was, we know growth stocks, technology stocks were strong. Is it now time for value companies to come into their own fold? Because these valuable companies were primarily companies that were hardest by the recession and the pandemic. And now if we are all going to get vaccinated and the world's going to go back to normal or super normal in the second half of this year, we would expect those stocks to start to appreciate. And they have to a large degree. Now, is this a great rotation? Have people been selling their growth stocks to fund purchases in companies like Exxon and Procter and Gamble? And the answer to that is no, they haven't. But we have seen a bump in the multiples that we're seeing on the value side of the equation. And so here's, basically the same chart. This is just the growth index. And you can see, I don't know, over here in the November kind of time frame, the appreciation that we saw there is reasonable and happened, but nothing terribly dramatic. And then we've had basically a pause since mid-February where these growth stocks have kind of, corrected a little bit, consolidated around that 50-day moving average, which is this blue line. And now started to break out again. It looks like investor enthusiasm is once again coming straight into the market after a very small correction. And on the value side, basically an unbroken, unmitigated bull market since that November vaccine announcement. The story that we've been describing here, the pandemic is going to end. We're going to have vaccinations, hopefully, and the variants will be hopefully effective against the variants, and we're going to go back to normal. And your airline companies and your hotel companies and real estate and all the COVID affected segments of the market and the economy are going to start to come back to life. And so I think market values are starting to reflect that and maybe then some. So the question here is the difference between value versus growth. Has there really been a rotation between the two? And so let me pull this up. So what you can tell from this particular chart here, as this chart goes up, what I'm looking at is the Vanguard Growth Index relative to the Vanguard Value Index. These are two index funds that you can buy on any given day, and this particular chart is one versus the other on any given day. And so if there's a cumulative outperformance by one versus the other, or by growth in this particular circumstance, you're going to see the chart grow. So when growth is outperforming, the chart is going up. And when value is outperforming growth, you'll see this chart going down. And what you can see is the general trend is investors have largely been preferencing growth stocks, with some acute periods where they didn't. Going straight into the pandemic, investors did slightly preference value stocks over growth, and then immediately flipped into growth. Once the kind of the shape of the lockdowns and everything kind of became clear, everyone kind of loaded into tech, and this chart takes off, as you can see. And then it peaks out here in that's basically September 1st, and it's been relatively flat. And the difference here is a flat period means that they're both performing at the same speed. And so as we saw in the last chart, they've been both increasing, but they've been increasing at a very, very similar rate. Now, the only real change, this idea of a great rotation, the only evidence of that is really this mid-February to early March timeframe, which is really just a tiny little correction. So the evidence thus far is that there has not been a great rotation. As value stocks have picked up, but growth stocks have continued to advance. So their relative value versus each other hasn't really changed since December timeframe when I put that video up. So there has not been a great rotation, as much as I'd like it to be. I'm a big fan of generally value investing and having discipline and rigor around stock selection rather than chasing a narrative. And so I want value stocks and quality stocks to win and outperform, but at the moment, that does not seem to be the case. This is still a euphoria and narrative-driven market. Another factor I'd like to show here, and so these are two different funds. Again, I'm doing a comparative chart here. This is the value index relative to an iShares quality factor fund. So the quality factor fund, what it does is it looks across the universe of stocks and it picks those with the highest return on equity relative to their industry peer group. And by doing so, a high return on equity is commonly seen as a metric of management success and management rigor and quality. There are other measures that you can look at. My personal preference is to look at credit default swaps. Basically, what is the price of insurance on their debt? If it's a low price, the market sees the company as a low risk, and if it's a high price, the market sees it as a higher risk. And you can see the same thing with credit ratings, but you want to see quality of a balance sheet. Well, in general, quality businesses tend to grow a little bit slower, but they tend to be better managed. And in a crisis, they should outperform. And that's kind of what you're seeing on this chart right here. So in general, historically, people conflate value investing with quality investing, and they're not necessarily the same. This particular chart is a 5-year chart, and you can see for the first 4 years of this time frame, there's not a lot of difference between these two, and that's what I'm describing. It's essentially synonymous, right? Quality companies trade at a cheaper price; they tend to grow a little bit slower than their growth peers, which have lower quality balance sheets, less revenues, less earnings. But you'll see there's a inflection point, and it basically started when the pandemic started and the recession started. Value stocks, as a category, underperform quality companies, and the difference there is a subcategory of value. So quality would be a subset of the entire value index. The value index itself has a component within them that are not high return on equity companies. These are companies that maybe have earnings decline, too much debt, very low quality earnings, and maybe very fickle customers that might leave them. And so what we saw were low price companies, and these primarily energy companies. It would be the biggest component in the index of this factor exposure. Energy companies underperform the broader market. So because we're going into a recession, people are going to use less energy less intensely. As we're not driving around, we're all locked in our apartments. So that segment dramatically underperformed quality. And very recently, this movement up that you see basically since October, so go into November is probably this little red dot right here, until recently, we've had a low quality value rally. So it's that segment of not terribly strong businesses with weaker balance sheets that have very, maybe bad credit prospects have rallied because they've survived this pandemic. And we see this often after recessions. Like you go into a recession, no one expects a particular business to survive. I mean, my favorite example is Citigroup in 2000 and early 2009. I mean, everyone's foreclosing on their homes. Who's going to pay their credit card payments, to Citigroup? Well, at some point, the government decided they weren't going to let any more banks down. And so had you bought Citigroup in early 2009, you made out like a bandit. But everyone, any intelligent investor would look at that and go, oh gosh, it's too much of a risk. It's too much, too weak. But this is what we've had coming straight out of this recession, starting in October, November. We've had a low quality rally, which I find fascinating. Another way to look at this, slice and dice these things. These are two iShares funds. The first fund is the Momentum Fund. And so what it's looking at is what is the price performance of this of the stock market? What's the subset that have had the best price performance over the last 12 months and the last 6 months? And they volatility adjust it and they get nerdy with it. But the idea is the companies that have gone up the most are likely to go up again the most. And so we're going to own those companies that have been performing very well in stock price appreciation. And then again, I have the quality index fund. So this is, again, these are two index funds. How are they going to perform relative to another? And you can see over the past 3 years, in the prior 2-year period, they're flat. There's no performance differential between a good quality company and a strong momentum. And that's what we call a high quality market, right? The investors are valuing businesses based on how strong those businesses are and how well they're run. And then we inflect into 2020 and everyone loses their mind. I don't mean that literally, but standards have changed. People started looking for narrative, and quality balance sheets, fundamental metrics, essentially at that point stopped mattering, and they didn't matter up until very, very recently. This February to March timeframe, we've seen a massive adjustment back into quality. And then in the last 2 weeks, it's gone away. And so, but you see, basically since June, momentum stocks, basically anything that's already moving, that's what's catching the bid. Quality, no one's really looking for. I'd posit as we go forward in time from here that quality is going to start to matter, because what's going to start happening is right now everyone forgives bad data, right? Like if your earnings are terrible and your guidance is terrible because you've had a recently bad exposure that you've experienced, that makes sense. And you look forward and you give guidance, you're like, okay, I think we're going to recover. So everyone's thinking on a forward basis that the recovery is going to be strong. These companies that they own are going to perform very well. Well, a year from now, these companies actually have to perform and do that. And there's going to be a big, big difference between companies that can fill that and can't. And the differential there is going to be basically the quality characteristics and the strength of those management teams and whether or not they can pull that off. And if they've been giving proper guidance on their forward earnings. And so I would posit that from this point forward, this momentum and quality is probably going to be more of a straight line rather than a general trend of just straight up momentum stocks and GameStop and all that kind of stuff. And then one last chart on this whole phenomenon. So this is the S&P 500 versus that quality index again. And what you can see in general, so I'll point this out. When this chart is appreciating, the index, the first index, which in this case is the S&P 500, is appreciating versus the quality index. And so the S&P itself has been in this very strong rally, outperforming the quality segment, subsegment of that index. And what that means is very low quality companies have been outperforming, or lesser quality companies have been outperforming quality companies. And again, I think you see this in a post-recession environment in that first year, and then it starts to dissipate and disappear in the subsequent years. And so here's for hoping that quality comes back and investors start looking at fundamental factors and looking at company performance and evaluating what the valuation of a business should be and what they should be paying for stocks. So, well, this is going to be a short one. I appreciate it. If you like this kind of content, please let me know. Give me a like and send me an email. So thank you for your time. I really appreciate it.